Okay, well, a very, very good morning to everybody. And once again, for those of you who've been with us for a little while now, thank you very much for your patience while we've got everything set up and waited to kick off. I'm delighted to be joined today by my colleagues. We have Sophie Lund-Yates here on the line, who's a lead equity analyst here at HL. And then also my colleague Joe Hill, who's a senior investment analyst and covers UK funds. My name is Nick Luff. I'm an investment specialist here at HL. I'm going to be hosting the session today. And just before we get going, I just want to remind everybody that this session is going to be exploring the UK market in a little bit more detail. We'll be lifting the lid and making the investment case for the UK. Now, what we are not aiming to do today is give you any financial advice. So this session is designed to give you information so you can come to your own conclusion as to what the investment opportunity is and whether or not that's something that interests you. We can give you advice. So if you would feel that you'd benefit from speaking to an advisor, just ask us and we can put you in touch with colleagues in the relevant team to do that. Now, we have an hour scheduled for this session today. I think it's likely to take us around 45 minutes to get through our content, and then we will make sure, of course, we use the rest of the time for your questions. Now, we do have a Q&A function in the webinar today, so by all means, pop your questions there in the Q&A, and then at the end, we'll review those questions and we'll answer as many as we can with the time we have available. So in terms of our agenda for today, we're going to start by thinking about UK assets, various different types of assets, of course, which are out there and available to investors. And we're going to just review how they've performed so we're all on the same page. We'll think about that domestically. We'll also put it into international context in the case of the stock market. We'll then dig into what it really means to buy British. So we'll lift the lid on the UK stock market makeup. We'll discuss exactly where an investment in a British index fund would go and what that means for you. And then we'll think about the investment case. So we think there's several reasons at the moment why the UK might be a compelling investment. Of course, there's never any guarantees with these things, but we're going to discuss those key drivers which we think make the UK perhaps more attractive now than it has been in more recent years. We'll review some success stories and also some not so successful cases just to bring it hopefully to life for you. And then finally, we'll discuss the kind of accounts that are available for you to actually make that investment if you decide that that's the right course of action for you. So without any further ado, I'd like to get started today by introducing for the first time my colleague Sophie Lund-Yates. Hi there, Sophie.
Hi, everyone. Thank you so much for joining us.
So Sophie, can you kick off, please, just by talking us through the performance of various different UK assets?
Yeah, sure. So obviously we've, sorry, bear with me 1 second. Good start, as always. Right. So essentially, as you can see here, there's a lot of different kind of buckets to choose from, if you like, but we're looking here specifically over kind of a 10-year snapshot. So essentially what this is showing you is how actually if you want a better chance of your investments doing well over the long term to make your money actually work harder for you, that tends to involve not leaving that left as cash. You can see that there in the light blue line at the bottom. But also a really important distinction to make out here is that yes, okay, so investing in the stock market, in particular in the UK stock market, looking at that yellow line, that yes, okay, overall those returns have absolutely been more positive, and that's a really important takeaway. But it doesn't happen in a straight line. So psychologically, that is something that investors need to always keep an eye on. It's something that we talk a lot about. We've got content on the website talking about making sure that you're prepared for those ups and downs, because it absolutely is a given when you're investing in anything. And at the same time, really, you can see it's kind of a similar story with real estate, but again, you've got those ups and downs where your overall trajectory hasn't actually been as high octane as investing in the stock market. So the moral of the story is, particularly when you're looking at inflation in the current environment, as well as much as it's coming down, inflation is never going to completely disappear. So if you want to make sure that your money is actually not being eroded and getting it working harder for you, that does tend to involve investing. But please do be aware of those ups and downs that you're going to see along the way.
Yeah, thanks, Sophie. I think that's a really wise words as always to get us started. Probably not the first time or the last time I should say that I'll say that today, I'm sure. So you kind of reference there inflation. You know, quite rightly the fact that over time inflation will essentially erode the buying power of your money. And although the stock market and other invested assets do give you a better chance of actually outperforming that inflation over the long run, although there's no guarantees, you just need to be careful of the fact that the values can go down as well as up, and therefore we do think that it's a long-term view. Also safe to say though that the
Exactly.
longer term you can invest, the more you could probably afford to invest in the stock market compared to say investing into cash.
Absolutely, that's exactly right. And just one distinction, I know I could talk about this slide on its own for a really long time, so I will wrap it up, but just a really important distinction to make there when you're talking about the long term is, again, it's that psychological aspect as well, is being prepared for
Yeah.
ups and downs. If you look, for example, at what happened in 2020, no one here needs me to explain what happened there. You know, that's quite a scary thing to go through at the time, but if you look at then the longer run after that event, the way that things can shape out as well. But as you say, nothing's guaranteed.
Yeah, perfect. Okay. So I think from this chart, if we took this in isolation, you'd probably be thinking to yourself, well, UK stock market looks like it's done pretty well, especially considering in the context of these other asset classes that are available. If we put this in an international context, though, Sophie, is that still the case? You know, can we talk about how the UK's done relative to the global market?
Sure. Well, with that in mind, you know, the picture does start to look a little bit different. So you can see here there's quite a gap there between ourselves and the global stock market. Now, one thing I would say, and I'm not going to talk too much about this because I will steal some of Joe's thunder later on, but essentially the UK has less exposure to some more exciting sectors, or certainly sectors that the market is more excited about. And by that, I'm talking largely about technology. So a lot of people here today will know that this is something in particular the press is very interested in terms of our exposure or lack thereof when it comes to higher octane tech stocks. But actually, and again, I'll talk about this a little bit later in a bit more detail as well, that lack of very kind of frothy behavior and excitement around the UK market and its relative underperformance compared to some other regions, for me, is actually something that can potentially make it a bit more compelling at the moment, and is why a large reason about why we're talking about the UK specifically at the moment.
Yeah, okay, really interesting. I think as an introduction, we'll park that there, as you say, Sophie, something that we could no doubt talk about for a long time. So hopefully that's been helpful for everyone. Just as a very quick scene setter, you know, so essentially UK assets doing well. Equities have outperformed inflation over a 10-year view, but in a global context, the UK has lagged behind there for the reasons that Sophie has touched on. So I'm going to move on, and I'm going to introduce my colleague Joe at this juncture. Hi there, Joe.
Hi, Nick. Thanks, everyone, for joining us this morning.
Joe, I wonder if you can kick us off then by just talking about, you know, what does it mean to buy British? So if you're going to invest in the stock market, where does your money, you know, actually go? What kind of things are we buying?
Yeah, absolutely. I think before we dive into that, Nick, I think a good place to start is just to take a look at the global market. So this slide in front of you excludes the UK, and you can see, you know, over that 10-year period, how the makeup of that global market has changed over time. And I think the important thing to note here that is as sectors perform well, they can become bigger parts of the index. So if we just take the technology sector as an example, so the kind of top bar on the screen there, if we look back to 2014, it was worth just over 10% of the global market. And over the 10 years since, that's grown significantly. And today it's just over 25% of that global market. So, you know, that won't come as a surprise to most investors, and lots of you will have heard of the so-called Magnificent Seven stocks in the US and the role they've played in driving that trend. But that is a key feature of the US market in particular. And if we just turn to the next slide, just to look at the UK market specifically. So just touching on the previous point there, that the big difference between our home market and the global market is the lack of technology exposure. And you can see that's been a real theme in the UK market. That sort of weighting hasn't really changed over that 10-year period. And there's a far greater presence of sectors like energy and materials, real big contributors to the UK stock market.
Yeah, really, really interesting. We've seen, from Sophie's introduction there as well, kind of the consequence of being underweight towards those sectors, which have been really, in favour with the global investors more recently. Okay, really, really interesting stuff. So I think probably with the scene well set by this point, I think it's probably safe for us to dive in now and think about, what is it then that we think about the UK might mean that now is a good time to be investing? These things that we've been discussing so far, these are big trends, aren't they? These are changes to the way that people live their lives ultimately, particularly with tech. So what is it that we think, is going to mean that the UK is well placed to deliver outperformance in future? So Sophie, you were touching before on valuations and the fact that the UK might be more lowly valued compared to some other international markets. I wonder if I can bring you back in as a starting point then, just to elaborate a little bit on that for us.
Yeah, sure. So again, as you were just saying, valuation needs to be looked at really carefully when it comes to the UK. Now, valuation, of course, value being very different to price. That's a very important distinction to make, and it does sometimes get lost in translation. Now, one of the reasons for that is the UK is home to, as Joe was just touching on, some sectors that it's not just that they're not tech, is that they are sectors that the market has been a little bit worried about. So that's things like big financials, the FTSE, for example, huge exposure to big banks. And actually, when the economic cycle is maybe in a weaker spot on that turn, naturally the market tends to get a little bit worried about banks because they're economic bellwethers. Now that's a simplification, and that's just one corner of the market that's been beaten up. But it's this kind of convergence of two things. It's that we haven't got as much exposure to tech, but also we've got some beaten up sectors. But what I would say is that within that is actually, we believe on the share research team that really what we've seen is that some of those valuation downgrades are really masking some high quality companies, and that those valuation kind of the bad mood with valuations is actually really been a little bit overdone in some corners of the market. So that's something that we need to look at, and the metric that we look at when we're kind of deciding this is known as a PE ratio, and some of our guests today will know that, but that is essentially showing you how much the market is prepared to pay for £1 of future profit. So a PE ratio, if you see that, which is what you're looking at here, that's what we're referring to, and you can see here really what the UK market or the FTSE 100 specifically is looking like compared to the US. And then also a cornerstone of the UK market is its dividend yield, which kind of sits around, it hovers between the 3.5 and the 4% mark, which is really quite a step up compared to regions like the US as well. So that's another area that I think is kind of being underrepresented or underappreciated in the UK market at the moment.
Yeah, really interesting. Okay, so I guess a question for you then, Sophie, would be, if we're saying that the UK delivers a high income, as in a high yield, that is suggesting low prices as well as kind of strong underlying earnings coming from UK companies, and we're also saying here that the PE ratios are lower, so investors are willing to pay less for essentially the equivalent amount of earnings from UK companies compared to their American counterparts. I mean, is it possible to kind of give us a sense, or can it be quantified even, as to, is there any fundamental reason for this? Is it simply this sentiment factor? Is it because the market doesn't really believe the sustainability of UK PLC earnings? Is there any other kind of factors at play, or do we really think this is just about sentiment?
Sure, absolutely. So a couple of prongs to that, really. So you're absolutely right to point out that a dividend yield is obviously a function of two things, one of them being a share price. So in some situations, yes, if something looks like it's got a very high yield on it, you have to look at that potentially with a pinch of salt, and actually think that's more related to expectations of the share price's future. But the UK is also home to what we would call we call them steady eddies, kind of colloquially. And then what I mean by that is, we have a lot of very big, they're not necessarily particularly exciting, but they're quite big, they're plodders, if you like. But actually, when you're looking at dividend paying potential, that is quite an attractive place to be, because growth might not be shooting the lights out, but it's relatively reliable. So you're looking at the likes of big consumer groups or things like telecoms, all that kind of necessary infrastructure that we have that helps feed into dividend paying potential, which is the corner of the market when we're looking at income that I think is very interesting. And then also when we look at the valuation question, you're absolutely right. Just because something has seen its valuation fall doesn't mean that thing is suddenly good value, right? Value versus price again. So what I would say is that I think in some situations, those downgraded valuations, they are absolutely highlighting genuine concern and some nervousness. But what we tend to see in broad brushed market moves like the UK has been through in recent times is what tends to happen is that overarching sentiment can bring down with it some high quality names and bring those valuations down unfairly because they're caught up in a wider sentiment problem. So it's a little bit of both.
Yeah, okay, that's really interesting. I mean, it clearly plays into what Joe was telling us all at the couple of earlier slides there as well. You know, your sort of steady Eddies theme there is exactly what we see when we do look at that breakdown of the UK market. So hopefully it's helping everybody start to sort of join the dots and get a good feel for what investing in the UK is all about at the moment. So if you've touched there on a couple of sectors which are of note in the UK, I wonder though if you can give us any kind of specific examples of companies which have done well, and also just for balance, companies which haven't done quite as well, and just give us a bit of a context as to what might be going on with those.
Sure, absolutely. So potentially not too surprising to some people here today, we have RELX on here. Now, despite everything we've just been saying, RELX is actually relatively techy. For kind of a more in-depth idea of what they do as a company, please do have a look at our share research on our website, where we've got kind of a house view on both of the stocks here on the left, actually. But RELX essentially, in a nutshell, it does a lot of data analytics and all kinds of parts of the spectrum that businesses need in order to function when it comes to that side of things now, including they do a lot of kind of compliance work and things like that, but a lot of analytics, a lot of data, a lot of tech. But they also have a exhibitions business as well. That's physical exhibitions. As you can imagine, that was really badly affected in the pandemic, and they've seen a strong rebound there as well, which has helped the market kind of breathe this sigh of relief. So there's a couple of things feeding into RELX's performance over the last year or so. It's also got quite a diverse background in terms of its revenue streams geographically, so it's not solely reliant on the UK, and that's a really important differentiator. And then also there's Rolls-Royce. Now, for anyone not aware, we're not talking about the car company here. This is the company that makes and crucially services wide body jet engines, so wide body simply being those planes with two aisles, therefore they're long haul flights. Now, as you can imagine, as Rolls-Royce makes its money based on how many hours those engines spend in the air, that's how they work out a lot of their revenue. The COVID era was really, really terrible, and that's a paraphrase. It was a really, really rotten time for Rolls-Royce, and what we've seen is that travel has rebounded in a really strong way, and therefore so has their fortunes. But the level of nervousness that was injected into the Rolls-Royce share price over COVID was so extreme that rebound has therefore been particularly positive. But at the same time, and in a similar vein to RELX, they are not solely reliant on revenues from the UK. So their fortunes definitely lie outside of our borders, despite them being London listed companies.
Fantastic. Yeah. Okay. So I think probably a bit of a theme appearing here then that businesses which have diverse sources of revenue is clearly going to help them in tougher times. And I think it's probably important as well just to point out at this point here that there is clearly a difference between investing in UK listed companies and the UK economy. Those two things are not the same. I guess it's because of this sort of diverse business model of these kind of large companies that is one of the factors as to why that's the case.
Yeah, absolutely.
Yeah. All right. And again, just a reminder to everybody that these are not personal recommendations. We're picking out a few hopefully quite interesting examples for you. But ultimately, past performance is no guide to the future. So by all means, have a look at the share research that Sophie alluded to there on our website. But please do come to your own conclusions on which securities you might want to buy or sell or not touch at all. Sophie, can you talk through a couple of examples which haven't gone the way that investors would have hoped?
Yes, I think that might be putting it lightly with a couple of a couple of these names. So as you can see on the right, Mothercare and Carpetright are names that have essentially, for want of a better word, they've failed in recent times. Now, as is not a surprise, they are both in the retail sector and they both have massively domestic focuses in the UK. Now, the problem here isn't just that, because what we're not saying today is that the UK is doomed and that just because something has a UK focus means it's going to fail. But the problem here was that sales began to fall because of the well-publicized fact that football, God, what's on my brain at the moment, footfall in retail spaces has been on a decline for quite some time, and particularly when you look at the likes of Mothercare, Carpetright, and those images that they invoke, they're very much physical estates, right? They were relying on people going there physically, and they failed to pivot towards the online shopping revolution quickly enough. That's particularly true in Carpetright, and essentially for both of these businesses, for all of the dynamics that were going on, what ultimately caused these companies to fail is the same thing that kills any company, and that is a lack of cash flow pumping through the business. And those are things that investors need to be really aware of, because it's all well and good saying you might like a product, you might think you understand what a business is doing, but before taking the plunge in investing, have a look at those numbers. It's really, really important. But yeah, essentially these are two retail businesses that failed to adapt quickly enough to a rapidly changing environment. And yes, they had relatively limited income streams. Mothercare a bit more than Carpetright. That's credit where it's due. But essentially, yeah, really, really tough conditions, and they failed to meet the challenge.
Yeah, okay, really interesting stuff, as always, Sophie. Thank you very much. Right, so I want to bring Joe back in now. And Joe, I guess so far we've been talking largely about investing in the index as a whole, so investing in the whole of the UK. We've also been discussing there through Sophie's comments just about the fact that sometimes individual companies which are fundamentally sound can get caught up in that wider sentiment. And I guess that kind of raises the question, doesn't it, about how do we go about actually identifying those companies if we as individuals don't want to be buying individual stocks? And I guess that's where we introduce the concept of fund investing in the UK. So Joe, I wonder if you can start then just by introducing us to fund investing, what it's all about, and fundamentally what do we need to be thinking of when we're starting our kind of investing journey into funds?
Yeah, absolutely. So I think the first thing to mention is you can invest in funds in two manners. You can invest actively or invest passively. As you touched on, Nick, predominantly so far we've been talking about investing passively. So that's investing in the UK market as a whole. And you can see from the dark blue line on the screen there, then that's the return you would have generated from investing in the FTSE All Share Index over the last 10 years. So that is representative of the whole UK market. And just below that, you can see the IA UK all company sector. So that line represents the average return from funds that sit in that sector that also invest in the UK market. But importantly, they will look different to the index. So the manager might choose to invest in a company to a greater extent than it's represented in the index, or they might choose not to own it at all. And I think you can see from the graph there, on average, active managers have actually underperformed the index over that 10-year period. But that is only an average. So if we look at the fortunes of two funds within the sector, so Fund A and Fund B here sit within that IA UK all company sector, and you can see you can get some very different outcomes depending on what you invest in. So that's why when investing actively, it's especially important to do your research. The range of performance outcomes can be much wider, shown by that divergence there, and that's something investors really have to bear in mind when choosing which fund to invest in.
Yeah, absolutely. So, and I guess just to sort of summarize the key characteristics for our audience, so if you're investing just to track the market, you can hopefully expect returns which look very, very similar to the index. I think safe to say generally over time, they do tend to lag ever so slightly just because you're paying a fee for that product, whereas the index doesn't suffer from charges. But as people can see also, active management gives the potential for much stronger returns than you get through an index, but it's not guaranteed. And clearly it can go quite badly wrong too. And you generally expect to be paying higher charges, Joe. Is that kind of a fair summary?
Yeah, that's correct, Nick. Yeah, I think that the charges are an important aspect to consider. I think what we'd say though is that if you get it right and do your research, you can see the difference in performance outcomes that can achieve. So it depends what's suitable for each investor, for their risk profile, the type of exposure they're looking for.
Yeah, 100%. And then just to be clear for everyone who's on the call today, we're showing you the performance in net of fees. So in the case of Fund A there, that's done very well. That's after you've paid the management charges to that particular fund manager. Okay, Joe. So I just want to touch then on when you're going through your process, when you and your team are looking at individual funds and thinking about which ones to actually put onto our wealth shortlist for clients. What is it that you're actually looking for? Talk us through the process that you guys go through and trying to sort the wheat from the chaff, so to speak, when it comes to fund selection.
Yeah, of course. So HL's fund research team conducts thousands of hours of analysis every year. We meet hundreds of fund managers, ultimately hunting for what we believe to be the best funds on the market. And in terms of what we look for specifically, so we like fund managers who've been investing for the long term through good times and bad. That means we can see how they've performed in those periods, whether they've stuck to their guns, whether they've cracked under the pressure. The process they employ should be repeatable. So it should be really clear to us how a fund manager condenses the universe they can invest in into the portfolio that ultimately is available to you as clients. So if we just think about that with a UK lens for a second, so there's around 560 companies in the FTSE All Share Index, which represents companies listed in the UK, and it's important for us to be able to really clearly understand how a manager assesses those opportunities, how they filter that universe, and how they arrive at a portfolio of typically 40 to 60 companies, depending on the fund manager's preference. So there's so many companies there that they've not chosen to invest in, and it's important for us to understand that process in detail. We also like managers who are open to challenge and debate, and those who consider all relevant risks, and importantly stated there, including from ESG factors. Even funds that aren't labeled as sustainable or responsible, we think should be considering ESG factors just as part of effective risk management, understanding the impact those factors might have on a company over the long term and the steps those companies are taking to mitigate those. And ultimately, Nick, we're just looking here to identify managers we think can add value through stock selection rather than just because their style's in favor. So, the style aspect, whether the particular area of the market the manager specializes in is out of their control. That can change from year to year. What we think is within their control is their ability to pick the right stocks within that area. So, that we think is a recipe for a long-term outperformance. And pulling all that together, as you say, we pull together the wealth shortlist, which is a collection of funds across different markets that we think have the potential to outperform their index over the long term.
Yeah, super, Joe. Thank you very much. So I just want to be clear, so everyone's on the same page. When we talk about ESG factors, we're saying environmental, social, and governance. So this is considering those three aspects in addition to the more sort of traditional financial factors as part of your investment due diligence process. Good stuff. Okay, so Joe, I guess one thing that you said there, which just caught my attention, and probably that of some of our audience today, is that when you pick an active fund, the manager is selecting a relatively concentrated number of stocks, sort of 40 to 60, I think you just said. So I guess one thing which people might be thinking at this stage is, well, that's pretty concentrated then. And so far, one of the things that we've been talking about is this idea of having a robust business, one which has kind of multiple revenue streams, diversity across different kind of business lines, perhaps as well. When we think about investing in the UK, what can we kind of think about, and what do you think your active fund managers that you like are going to be kind of assessing as a kind of key strength in the UK when it comes to that revenue diversification?
Yeah, absolutely. So if you just take a look at the slide on the screen here, so this shows you where companies listed in the UK earn their revenues from, effectively where their customers are. So, it's broken down by region there, but ultimately the key takeaway is that investing in the UK stock market is really not the same thing as investing in the UK economy. They're very different things. So you can see here, at a headline level, the UK stock market is more reliant on the US consumer than it is the UK consumer for revenue. So, it really isn't, the be all and end all, of the market success, where the UK economy is. You can see, Asia features in there, Europe a significant contributor. So really, companies in the UK are global and they're earning revenues, from across the globe. So, the UK is stacked with global businesses, selling their goods and services all around the world. And, I think that's reflected in the diversity of the regions represented there. Yeah, clearly the UK is an important aspect to it. And, generally smaller companies are more reliant on UK consumers for their revenues. As you go up into the FTSE 100 of featuring the largest companies listed in the UK, they tend to be the more global, more mature businesses. But there's a real diversity of revenue sources there, as you can see.
Yeah, absolutely. I mean, there's an old adage in markets, isn't there, which is when America sneezes, the whole world catches a cold. And I guess things like this is probably a reasonable example as to why that sort of adage is banded around out there. It's just that the size of the US market is so influential to other regions, and this is a really good example of one of the reasons why that's the case. So we're talking here, Joe, about revenue exposure and the fact that it's really diverse geographically. I wonder if we can drill another level down here and think about, what happens when we think about the income from the UK market from different sectors, and also kind of up and down the cap scale of, larger companies to smaller companies.
Yeah, absolutely. As you mentioned, Nick, the attractiveness of the UK stock market as a whole, one of the key factors that's always pulled out is its income generation potential. It's known as a good market for achieving a decent level of income, but a common criticism of the market is that it's too reliant on a small number of sectors for those dividends. And you can see in the pie chart there that there's some truth in that. You can see banks and financials as well as oil, gas and energy companies contribute significantly. So combined, those sectors account for just under 40%, about 38% of the market total. So there is some concentration there. I don't want to sort of overlook that, but I think it is also important to say it's not just those sectors contributing all of the market dividends. There are a range of other sectors also contributing meaningfully there, and you can see that on the chart and represented through the range of sectors there that feature consumer discretionary stocks, healthcare, a decent contributor as well. So there is a range there. It's not just reliant on those sectors. And I think just to touch on the table on the right hand side of the screen as well there. So we're seeing something quite interesting in that mid-cap part of the market at the moment. So by mid-cap, I mean medium-sized companies, and that's represented by the FTSE 250 index there. Those businesses are typically faster growing than larger companies, which are represented by the FTSE 100. And normally, because they're faster growing, you'd expect to see the mid-cap part of the market with a lower yield, and that's as a result of those companies, having more growth opportunities to reinvest in. And so rather than paying out a dividend to their investors, those companies are investing to fuel their growth and potentially become the larger companies of tomorrow. But I'm sure everyone on the call won't need much reminder of this. Over the last couple of years, we've seen a series of interest rate hikes from 0.1% right up to 5.25%. And because of this, the mid-cap part of the market and small caps to a similar extent have been really hurt by rising rates and haven't performed as well as larger companies. And I guess just to quantify that, what do I mean by haven't performed as well? Since the start of 2022, medium and smaller sized companies have lagged their larger counterparts by around 20%. So, it's not an insignificant gap. And the result of that is the mid-cap part of the market is now offering a similar yield to investors in addition to good growth potential. So we think you're getting a fair bit of bang for your buck in that part of the market.
Okay, Jay, that's super interesting. And again, it comes back to the conversation Sophie and I were having a little bit earlier there, which is when we talk about income and yield, it's a function of not only what is the actual income that companies are generating to pay out to their shareholders, but also price. So again, it kind of reflects the fact that this sort of sector of the market very beaten up off the back of COVID. Lots of nervousness about smaller companies who are generally seen as kind of less resilient. However, again, I think the slide that's on the screen here now is going to give people a pretty good idea as to why we now think now might be a time to be a little bit more optimistic. Joe, can you just elaborate for everybody on exactly what we're seeing on the screen at the moment?
Yeah, absolutely. So, just reference there about the interest rate cycle, interest rate rising cycle we've been through in the last couple of years. I think, the general consensus in markets now is that interest rates have peaked. There's a lot of debate on when they might begin to fall. There's lots of debate about whether it might be the summer or the autumn, but generally most people are convinced we're at the peak now. So, we thought it'd be useful to show you what's happened in the past when interest rates have peaked and what's happened after the first rate cut in those cycles. So I guess just to make everyone aware of what we're showing here. So this is looking at the last 34 years. And over that time period, there have been 9 interest rate cutting cycles. So that's when, the first time the Bank of England cuts rates from, a previous peak. And as you can see, we split out the timeframes from that first interest rate cut over 1, 3, and 5 years. And I guess the first point to make here is there have been attractive returns from across the market over those time periods. They're positive returns, likely to beat inflation with those returns over 1, 3, and 5. So, it's been a good place to be. But I think, most people will probably be particularly drawn to the medium-sized companies. When we referenced that on the previous slide there, represented by the FTSE 250, and that part of the market has delivered some significant outperformance. So you can see, to a lesser extent over 1 and 3 years, but over 5 years in particular, a significant margin of outperformance versus other parts of the UK market. And, I think it's probably important to remind people here that, when investing in funds and investing in the stock market, that is the minimum time frame we normally like to consider. So that 5-year period, investing for a shorter time period than that, is likely to be, a lot of volatility along the way. We think 5 years is the minimum time frame there. And, as I referenced, Nick, you'd likely be happy with those returns over 5 years compounded from all parts of the market there. But there's something really interesting about how that kind of mid-cap part of the market responds to that rate cutting cycle.
Yeah, super stuff, Joe. Thank you very much. So again, just a reminder for people here that I think that one of the key takeaways from my perspective is that we're seeing here that the longer you can invest for, ultimately the better the chances are that you get back more than you put in. These are averages though, so it's not necessarily saying that this is how it's happened every single time there's been a rate cut, and obviously every interest rate cycle is slightly different. There's going to be different geopolitical factors going on in the background there as well. So we can't be guaranteeing, that this is how it's going to happen in the future. Really important to say past returns are no guide to the future at all. But nonetheless, it's really interesting to see, and you can see that after these rate cut cycles, that is historically when it has signaled a pretty good time to invest. Okay, so just to summarise then, Joe, I mean, I think we've talked a couple of these already. We've talked about attractive and growing dividends in the UK market. We've talked through Sophie's section today just about UK stocks trading on discounts. Can you talk about share buybacks a little bit though? We've got that here as one of our kind of key drivers, which might mean now's a good time to be thinking about investing in the UK.
Yeah, absolutely. So I guess just to kind of set the scene a little in terms of what we mean by share buybacks, that's simply companies choosing to buy back shares with the money they've got left over, after having paid debt holders, after having paid the costs of running the business. And this is a theme that's commonly been associated with the US market, in recent times more than the UK. But in the last couple of years, it's been a really material contributor to the yield that investors can get. So just in terms of why a company might buy back its own shares, well, the key factor in that is the valuation it's trading on it in the market at that time. So, companies are in business to make money, and when they make a profit, they've got options, with what they can do with that. And, they can choose to pay it out to shareholders as a dividend. They can reinvest in growth opportunities for the future, or they could buy back their own shares. And, generally company management teams making that decision will do the latter and buy back their own shares when they think they're undervalued by the market. That there is a kind of signaling effect there, effectively, standing up and kind of waving a flag saying, we think our shares are trading too cheaply. And if the market isn't going to reflect that, then we will buy them back ourselves. And this isn't something that now we're seeing happen at the margin. So taking 2023 as an example, 40% of the FTSE 100 bought back their own shares in that year. So the FTSE 100 is the 100 largest companies listed in the UK. So 40% of those, took that action because they thought their shares were trading too cheaply. So, we think that could be a really interesting driver of returns should that continue. There's no guarantee it will, but I think it's a reflection of where the market is trading at. And, kind of ties into the point on the kind of right hand side of the screen there, the discount that the UK market trades on versus some of its international peers, somewhere between 20 and 40%, depending on which market you're comparing it to. Clearly that's movable, but an interesting opportunity versus similar established stock markets elsewhere. And and finally, just on income as well, we don't think share buybacks this year are coming at the expense of income growth. So at a market level, dividends are expected to rise by around 4% or so this year, which we think is a pretty attractive growth rate. When you consider the fact that the shares are trading on a discount, generally you're getting that income growth, and there's share buybacks going on. We think the combination of those factors mean it could be an interesting time to be investing in the UK.
Thank you very much, Joe. That's really, really interesting for everybody, I am sure. Okay, so I'm gonna move on ever so slightly now into the next section of this webinar today, and I just want to touch upon a summary really of HL's house view on UK asset allocation. Now, there's lots of kind of ways that we can think about this. To be honest, I mean, probably the purest expression of HL's house view is through what we call our strategic asset allocation. And that is essentially a committee within HL who decide on a regular basis how we think we should be allocating our portfolios across different levels of risk. Now, we are just about to launch a new range of funds, so the HL multi-index funds. And they are, I guess we can see them as a pretty pure expression of what that strategic asset allocation looks like. They're designed just to be a whole portfolio in a single investment. So if anybody invests into the multi-index funds, you will get those that will be kind of managed and overseen by HL. You won't have to worry about rebalancing the portfolio. We'll do all of that for you inside the investment, and you'll get that kind of ongoing benefit from having us change those investments as our house views change. And we think they're excellent value as well. So the funds are just 0.3% for all that underlying investment, the management that you get from those, and as I say, that kind of hands-off approach. And that's the charge for the investment. You then pay the HL platform fee, which varies depending on which accounts you choose and several other factors. But you'd have a max total charge through the multi-index funds of 0.75%. So we do think they are an excellent value option for investors. Now, on the screen here, you've got a overview as to what our allocations are for these funds. These are just our neutral allocations. They don't take account of any sort of tactical positions that we might have, which we have the discretion to make. And worth also just pointing out that these funds are run by our sister company, Hargreaves Lansdown Fund Managers. Now, they do launch on the 6th of June, so very, very soon. And we are doing an offer if you invest before the launch. We are offering a fixed £1 launch price on any subscriptions that you make in advance. But of course, you'll be able to buy into these and sell them at any time thereafter, just at the normal unit price. I think relevant to the section for today, though, really is just if we focus on the tables below each of the donut charts that you've got there on the screen, this is giving you an idea as to how much UK exposure you would have if you invested just based purely on the size of the UK market relative to international markets, which is what we call a market cap approach. So the neutral exposure there, as you can see, it does go up as you go up the risk spectrum from cautious through balanced all the way up to adventurous, and that's simply as you increase the exposure to the stock market, then naturally your weight to the UK would also increase. But what you can see in these portfolios is actually that HL's house view at the moment is actually we are quite constructive on the UK. It's worth just being really clear that all of these views are expressions of our 10-year outlook, so very, very long term. Because of that, we're not here taking a stance on individual events that are more short-term in nature. So things like interest rates as they are today are not reflected in these positions, nor are things like geopolitics. Obviously, everyone will know that this is a bit of a crazy year for global elections at the moment. We're not reflecting those sorts of events in these views. They're designed to look through the full market cycle, and we're investing here based on really what we think over a very long-term view the relative attractiveness of different markets is. So things like the PE ratios, Sophie mentioned earlier, are going to be just an example of the sorts of factors that play into those models. But yeah, a nice opportunity for anyone who wants to invest and kind of get their money working hard for them, but you don't want to do the kind of individual fund selection or even an individual stock selection. If you just want to sit back and leave it to the experts, then the multi-index funds are just one option available to you. Okay, and I think it's also worth just making sure that everyone is clear on what kind of accounts are available to you. And if you do decide that now is a good time for you to be putting some of your money to work, then you firstly, of course, to decide, well, which account can I invest into? You know, how do I actually make those steps into investment, particularly if it's newer to you? Well, I think a good place to start is really just to think about what is your time scale. Now, we've seen today, hopefully consistently throughout this theme, that the longer you have to invest, the more chance you have of getting back more than you put in, and the less time you invest for, the more uncertain that outcome is going to be, just given that nothing is guaranteed if you invest into stocks and shares. So generally speaking, if you are thinking just very short term, so for example, less than say 5 years, you might decide that based on your risk profile, you don't want to invest at all. And that's, of course, absolutely fine. Now, if that sounds like you, then I just draw you to the fact that we can still help you there. We have what we call active savings at HL. And essentially, this is a single account which allows you to shop around for the best bank savings rates on the market. All of those are served up to you through one single account with HL, meaning that you don't need to actually physically transfer your accounts between banks to be chasing those rates as they change. So it's a really flexible approach to cash management, and we can offer that to you in a tax efficient cash ISA wrapper, and also if you're saving outside of your ISA allowance, just as a standard taxable savings product too. Now, if, however, you're going above that 5-year mark, you might be thinking, well, yeah, inflation risk at this point, from my perspective, becomes greater than the risk of actually getting back less than I put in, and therefore I'm willing to take some investment risk. Now, you've got a couple of options available to you here. On a tax efficient front, of course, you have a stocks and shares version of the ISA, which allows you to buy individual shares or funds and hold those free of any further tax once you have made that purchase. If you're looking for tax efficient savings on a longer term, then you have a pension option through HL. We offer a SIP, that's a self-invested personal pension. I'll come back to both of those two options in a moment. Now, if perhaps you've already used up your ISA and pension allowances for this year, perhaps you want a little bit more flexibility, and then a fund and share account is also available. There is no limits to what you can pay into a fund and share account. The only thing to bear in mind really is that these are not tax sheltered. So in theory, if you've used up all of your allowances, you could be subject to further income tax, tax on dividends, or even capital gains tax if the investments go the way that you would, I'm sure, want them to. So let's talk about ISAs in a little bit more detail. And I've got one eye on the time. I want to make sure that we have lots of time to circle back for Q&A at the end too. So as we say, ISAs are generally speaking one of the first things that people are encouraged to save into, and then the last place that you withdraw from, simply because of the tax efficiency that they offer. So as I say, a standard stocks and shares ISA, you have a £20,000 ISA allowance in the current tax year. You can split that as you like, though, between cash and stocks and shares ISA types, or you can put all of it into one or the other, but you can't have 20 per ISA. That's an aggregate limit for all of your ISAs. Now, in addition to the stocks and shares ISA, there is also a lifetime ISA product out there on the market and available through HL. This is available to anybody aged 18 to 39. You can pay £4,000 a year into your lifetime ISA, and the big benefit here is that they benefit from a government bonus of 25% on top of any contributions that you make. They are designed primarily to help people get onto the property ladder. So that is the main use case for a lifetime ISA. And if you make that withdrawal when you're buying your first home, then you can do so without any kind of exit penalties. But penalties can apply in other circumstances, so do just be careful. Alternative for a lifetime ISA, they can be used as alternative savings vehicles for retirement. So again, no penalties to withdraw if you withdraw after you've reached the age of 60. So a little bit different to a pension. If you need more information on that, the best thing to do is just get in touch with HL and we can certainly help you out with that. And then finally, worth, of course, calling out the junior ISA as well. So this is a ISA specifically set up for children. You can save up to £9,000 a year in the name of that child. And through HL, we do not charge a platform fee at all. So you can get your children off to a great start with their own investment account, and you won't pay any platform fee to HL for doing so. But of course, remember, other charges may apply, for example, the charge on the underlying investments that you pick. Just tipping my cap very, very quickly to pensions. Again, pensions are an incredibly tax efficient, if not the most tax efficient way for you to save. Of course, the trade-off with a pension is that you lose access to that money typically until you reach your minimum pension age, which is currently 55, but it is rising to 57 in 2028. Now, any money that you pay in, you do get tax relief on your highest marginal rate. So if that's basic, 20%, higher rate, 40%, etc. And of course, different rates apply in for Scottish taxpayers as well. Now, with pensions, they're really generous allowances. You can personal kind of what's called your relevant UK earnings, which effectively is your taxable income with a few modifications to that. And again, contact our pensions help desk if you've got any questions here, and we'd be very, very happy to talk you through all of these rules in a bit more detail. But again, a really, really efficient way to make sure that you are investing as much as possible, and therefore growing your pot as large as possible for your future. Okay, I mean, that draws us to the end of our session today. So we're 50 minutes in and we've got about 10 minutes left for questions. So what I'm going to do now is just pause for a moment. We'd be very appreciative if you can just spend a couple of moments just reading through this important information